Hello, welcome to this program on Psychology of Online Forex Trading. My name is Kiran Kumar. I am the CEO of Forex Veda India Limited. I have been a Forex trader since 18 years. In my 18 years of experience, I have seen thousands of Forex traders losing money. Thousands of Forex traders have approached me to repair their damaged accounts. They came with the statement. All the statements looked same. After all, Forex trading is 99% psychological, 1% technical.
Hello again. In the introduction video, I said every trader made same mistakes. What are the two most common mistakes traders commit? When I say traders, I mean not just Forex traders, but stocks and commodity traders also. Mistake number 1, buy high, sell low. Mistake number 2, take quick profits and hold on to loss-making positions. These are the two mistakes almost every trader makes. Reason? 100% psychological. When investors approached me and told me that they lost money in Forex, I used to tell them, you lost not because the market moved against you. You took quick profits and held on to loss-making positions, right? They all admitted it was true. I could say this without even looking at their statement. Almost every trader makes this mistake. Let us assume a situation. On 1st of January, trader A sold gold at $1,500 per troy ounce and trader B bought gold at $1,500 per troy ounce. Let us say today, on 1st of June, gold is at $1,000 per troy ounce. My question to you is, how much profits trader A is in and how much loss trader B is in? I'm sure you will answer, trader A is in $500 profits and trader B is in $500 loss. But that is not correct. Trader B is in $500 loss because he is still holding on to the position. But trader A closed the position when gold fell to 1490. In this trade, both the traders entered the trade at the same time, but one trader is losing $500 while second trader made just $10. This is the reality. This is what is happening in the market. Who says there is no guaranteed way to make money in the speculative market? If there is a guaranteed way to lose money in the trading, then the opposite has to be true, right? The two mistakes I mentioned just now will turn your account to zero. Guaranteed. Do you agree? What is the opposite of guaranteed loss? Guaranteed profits. If you want to double your account, just do the opposite of these two mistakes. It's very easy to say but very difficult to practice. You have to be like a machine or a robot. No emotions at all. I used to recruit housewives to trade for me. I used to make them trade for me based on my instructions. They had no decision-taking powers. They were my robots. I won a prize in King of Mini Trading contest in 2003. And I won because account was traded by my home-based staff. She was my robot. If I had traded myself, I would not have made so much of profits in 1 month. Hello and welcome. In the previous video, I explained what are the two mistakes the whole world commits. In this video, I am going to explain why do traders commit these two mistakes. Let us go to mistake number 1. Buy high, sell low. The three reasons for making these mistakes. Number 1, listening to the market noise. Number 2, no courage to bottom pick. And number 3, delay in taking decision. Whether it is Forex, stocks or commodity market, when the market crashes, you will find no buyers. They are all afraid that market may crash further. Smart investors start buying at this level. Other people just observe. When market starts moving higher, they start thinking, shall I buy? Will it go up further? Then they think that no, let me watch the market for some more time. They see that their friends have bought. Then they see that their neighbors have bought. Then they read in the newspaper that stock index is likely to go to 40,000. Finally, they gather enough courage to buy stocks when the index is at 40,000. As soon as they buy, the market will start correcting. It will fall to 30,000. I've heard many people saying this. I'm so unlucky. If the market is going up, the moment I buy, it starts falling. The moment I sell, it starts going up. No, they are not unlucky. They are late. Let us say stock index went up from 10,000 to 40,000. At 40,000, if you read Financial Journal or watch financial news, you'll find people talking about market going up further, maybe to 50,000. At 50,000, you'll find people talking about market raising to 60,000. Same thing happens when market is falling. If market falls from 60,000 to 50,000, people will be talking about market falling to 40,000. At 40,000, they'll be talking about 30,000. At 30,000, they talk about market falling to 20,000. If you listen to market noise, when will you buy or when will you sell? This is what happens in the market. So-called unlucky people buy at high and sell at low. The moment they buy, market starts falling, and the moment they sell, market starts rising. Mistake number 2, taking quick profits and holding on to loss-making positions. Let's see why do most of the investors commit this mistake. KK's theory of hope and fear explains this. Who is KK? Yours truly, Kiran Kumar. When market is going against the investor, he hopes that market will bounce back. So he holds on to the position. When market is in his favor, he is afraid that market may bounce back and he may lose all the profits. So he grabs the profits quickly. So biggest enemy of a trader is frustration. I'll give you a good example of how market can frustrate a trader. Let us assume that on 1st of January, you invested $10,000 and went for a long Euro USD position. You opted for a long-term trade. You decided to hold this position till your account makes 50% profits. 1st of February, when you watch the account, you notice that your account has become $14,000. Wow, that is a profit of 40% just in 1 month. Okay, I'm going to hold my position till I make 50% profits. 1st of March, you check the account. It has come down to 13,500. This time you'll start thinking if your decision to hold on to profit making position was right or wrong. 15th of March, you see that account has come down to 13,000. Now you start believing that you should have taken profits. 1st of April, account is at 12,500. You start getting frustrated. 15th of April, account comes down to 12,000. More frustrations. You'll start thinking I should have taken profits at 14,000 and I could have bought back the positions now. 1st of May, account becomes 11,000. Now you feel more frustrated. 15th of May, account becomes 10,000. Back to square one. You'll feel like kicking yourself. You start repenting on your decision of keeping the position for big profits. 1st of June, account becomes 11,000. What will you do? You'll just close the positions. You'll think that if I don't take profits now, I may lose this also. This is what happens to every trader. Watching the profits disappear is very frustrating. That is why hardly any trader takes big profits. People who actually made fortunes in stock markets are those who bought stocks in 80s and 90s and dumped it somewhere and never looked at the market value. They all became millionaires. People who sit and watch the market all the time lose. If you're watching the market every day, it is nearly impossible to hold on to profit-making positions. Why do people hold on to loss-making positions? I'll give you an example. Let us say you bought a stock at $80, kept a stop loss at 60 and targeted 100. Market falls, takes your stop loss and then moves to 100. How will you feel? You feel frustrated, right? So next time when you do a similar trade, when the market falls, you will move the stop loss from 60 to 50, then from 50 to 40. When market pulls back, you close the position in $2 profits. What does this experience teach you? If you hold on to a position, you can close it in profits one day. This is what your experience does to you. It deceives you, it cheats you. It tells you to take profits quickly or else you are going to lose it. And hold on, no need to cut loss. Market will bounce back. Because of this experience, every trader does this mistake of holding on to loss-making positions and taking profits quickly because their own experience deceives them. In the next video, I'm going to teach you 3 techniques. These are emotional management techniques. These are strategies which can help you to trade with a cool mind without getting frustrated. Stay tuned. Hello and welcome. In this video, I'm going to teach you first of the 3 strategies which can help in emotional management. If you follow this strategy, you will not get frustrated and you can trade with a cool mind, which is very important to make profits in online trading. First strategy is like this. Let us say you wanted to buy 3 lots of Euro USD at 1.1200 with stop loss at 1.1100 and target of 1.1300. Now what you should do here is, instead of opening one single position of 3.0, you open 3 positions of 1.0 each. Instead of keeping one stop loss and one target, you keep different stop loss, different target. For example, for one position, you keep 40 pip stop loss, 40 pip target. For the second position, you can keep 60 pip stop loss, 60 pip target, and the third position you can keep 100 pip stop loss and 100 pip target. If the currency pair falls to 1.1200, all three positions will get stopped out, but your loss will be less because you took 40 pips, 60 pips and 100 pips losses. That means you'll be making a loss of 200 pips instead of 300 pips, right? There is always a possibility here that only first stop loss is taken out, but after that currency pair moves up and you make profits in second and third positions. Another possibility is currency pair going up. Let's say first target reaches at 1.1240. From there, if it comes back to 1.1200, you can buy back that position. In case if it goes further up, you can close the position at 1.1280, that is the second position. From there, if it goes up to 1.1300, you can take profit there also with the third position. But in case from 1.1280, if it falls back to 1.1240, you can buy back. So again you have two positions now. From 1240, if it goes up to 1.1280, you can probably take profit in that position. So you can keep on doing this. By doing this, you can actually improve your average. So by the time it reaches 1.1300, instead of making 300 pips, you can actually make 500 pips by repeating these trades. Second strategy is safe martingale. Martingale in its original form is a very dangerous strategy. This is an averaging strategy. People have used martingale robots and lost all the capital. This robot can give you good income in the beginning, but it can blow your account up in just one day. For example, you start using it today. For next 30 days, you can make a lot of money. On 31st day, probably your account will become zero because it has no stop loss. How does this strategy work? It works like this. Let us say euro is at 1.1200. You buy 0.01 lot here. If it falls to 1.1170, you buy 0.02 lots. At 1140, you buy 0.04 lots. At 1.1110, you buy 0.08 lots. So you go on doubling the quantity, and when market corrects a little, say 30 pips, you close all positions and you'll make some profits. To use this strategy, you need unlimited capital, and the risk to reward ratio is very poor here. You are risking the entire capital for a reward of just 30 pips. What I have done is, I have created a robo called Safe Martingale that can be manually controlled. You can trade your account with the help of this robot, or you can manually execute the trades also. Let me explain why should you use this strategy. Let us say Euro USD went up from 1.1200 to 1.1300. So there are two trading methods one can use. First one is buy low, sell high. And second one is follow the trend. As per the first method, that is buy low, sell high, you are supposed to sell at 1.1300. If you sell at 1.1300, where will you keep stop loss? If you keep a stop loss at 1.1330 and target at 1.1270, currency pair may just go up, take out your stop loss and then fall. This will frustrate you, right? Second method is to follow the trend. So if euro has gone up from 1.1200 to 1.1300, that means the trend is up. So you are supposed to follow the trend. So you have to take a buy position. If you buy at 1.1300, where will you keep the stop loss? If you keep a stop loss at 1.1270 and target at 1.1330, it may just fall to 1.1270, take out your stop loss first and then move higher. This will also again frustrate you, right? So what you can do here is apply safe martingale strategy. Buy 0.01 lot at 1.1300, 0.02 lots at 1.1275, 0.04 lots at 1.1250, stop loss for all at 1.1225. At the same time, you can sell 0.01 lot at 1.1300, 0.02 lots at 1.1325, 0.04 lots at 1.1350 and stop loss for all at 1.1375. So whenever your position reaches 35 pips profit, you'll be closing all the positions at once. So in this example, possibility is very high that you make profits in both the buy as well as sell trades. Let me explain you the profit and loss calculations. If your position touches stop loss at 1.1225, you're going to lose 25 pips in 0.04 lots, 50 pips in 0.02 lots, 75 pips in 0.01 lot. That is net 275 pips minus 35 pips, that is equal to 240 pips. Where does this 35 pip profits come from? This 35 pips is the profit you are going to make in the sell trade. At 1.1300, you sell 0.01 lot, which touches profit at 1.1265. Let us see how much profit you make if the third entry touches profits. You make 35 pips in 0.04 lots, 10 pips in 0.02 lots, and 15 pips loss in 0.01 lot. We have to add 35 pip profits made in short trade also here. So net profit will be 180 pips, that is $18. See, either you can do the above trades manually or just tell my EA to take position at 1.1300. Hello and welcome. My third strategy is called as reverse trading technique. Let's imagine a trading room where there are two traders. Trader A is trading with $300 and trader B is trading with $30,000. Trader A takes quick profits and does not keep any stop loss. Trader B watches the trader A and takes opposite positions with 100 times the quantity. That means when trader A buys 0.01 lot, trader B sells 3.0 lot. When trader A sells 0.01 lot, trader B buys 3.0 lot. What are the chances of trader A making money? He may make some profits in the beginning, but within a month or two, he will surely lose the entire capital. What will happen to trader B? Trader B may lose some money initially, but within a month or two, he will double his capital, right? Theoretically, yes. Practically, he may make 50% to 80% profits because trader B is losing some money in spreads. If we can say trader A will surely lose his capital, then we can say trader B surely makes 50% to 80% profits, right? That means opposite of guaranteed loss is guaranteed profits. Do you agree? Reverse trading technique. This is the easiest system to make money in Forex trading. This system works on two principles. First, trading demo account is much easier than trading live account. Second one is losing is easier than earning. If you want to lose a $300 account, you can easily do it, but to double the account, it's difficult. In this system, you trade a $300 account and you try to lose the capital. When you lose $300 in demo account, you make $2,000 to $20,000 in your live account, depending on the ratio you use. For example, if you're using 1:10 ratio, that means you are trading 0.1 lot in demo account and you'll be trading 1.0 in your live account. When you lose $300, you'll not actually make $3,000 in the live account because you lose some money in spreads. So I take it as around $2,000. That means with 1:10 ratio, when you're losing $300, you'll be making around $2,000 profits in your live account. This system requires a software or a simple EA. My students can buy the software from forexweather.com at a discounted rate. You can link your demo account to your live account using this software, and software will look at the trades in your demo account and does the opposite trades in your live account. The trade happens within seconds. Look at this example. Demo account is $300, live account is $20,000. Here you buy 0.1 lot Euro USD at 1.1300. What happens in live account? It sells 2.0 lots Euro USD at 1.1299. The difference in these rates, one is a ask price and the other one is bid price. So here in the demo account you close at 1.1310, whereas in the live account you'll be closing at 1.1311. Here you make a profit of $10 in the demo account. There in the live account you are losing $240. Now you do the second trade. You sell Euro USD at 1.1310. The live account, the software will buy automatically at 1.1311. So here you close at 1.1620. In the live account it will be closed at 1.1619. So you make a loss of $310 in the demo account. In the live account you are making a profit of $6,160. So demo account becomes 0 and the live account makes a profit of $5,920 net profit. So this is just a theoretical explanation. You cannot easily lose the account in 1 or 2 trades. You may have to do little more trades, maybe 5 or 10 or 15. So more trades you do, less profits you make because you'll be losing some money in the spreads. So it's always good to lose the entire money in the demo account with as few trades as possible. Sometimes my clients ask me, what if I make money instead of losing? Of course, if you earn money in demo account, you lose money in live account. But if you keep a strategy of take quick profits and hold on to loss making positions, You may make initially in demo account, but you will lose all within a week or month. At that time, your live account will make losses initially and earn huge profits later when demo account gets wiped out. Advantages of this strategy are you're trading and you're watching only the demo account, so you can be really cool and trade without any emotional problems. You don't have to be an expert to lose money. You don't have to know any fundamentals or technicals. You don't have to be careful and watch the market all the time. You have to do that to make money, not to lose money. You can just open a trade, keep a small profit limit, and just go for a movie or a drink. When you come back, you may notice that your demo account has become zero. In a worst case, demo account may make some small profits, resulting in a small loss in the live account. To lose, all you have to do is to make these two mistakes. Buy high, sell low, take quick profits, and don't keep a stop loss. When I say buy high, sell low, you don't have to be really good at guessing. When you enter the market, when you take a position, just make sure that the market is either at the high or at the low at that particular time. So if market has gone up, if the currency pair has gone up, just buy. If it has fallen, just sell. Don't worry whether it will fall further or whether it will go up further. If you make the above two mistakes, I can guarantee you that your $300 account will get wiped out in no time. So your live account will surely make profits. Some traders ask me if they can use all the three strategies in a single account at the same time. The answer is no, you cannot. But you can use two strategies in a single account at the same time. Let's look at strategy 1 and strategy 2. What do you do in the strategy 1? You divide the position into 3. Instead of opening one standard lot, you may be buying 0.3, 0.3 and 0.3, right? And in strategy 2, you go for 1248 or 124816. Yes, both these strategies can be used in a single account at the same time, but not on the same currency pair. For example, you're trading Euro USD and you are also trading GBP USD. You can use strategy 1 in Euro USD and you can use safe martingale in GBP USD. But safe martingale works best if there is not much movement in a currency pair. GBP USD normally moves a lot. So what you can do is you can use strategy 1 for GBP USD and you can use strategy 2, that is safe martingale, for Euro USD. Okay, now let's look at the strategy 1 and strategy 3. Can we use both the strategies in a single account at the same time? No, you cannot. Why? The strategy 3 is reverse trading system, and the purpose of reverse trading system is emotional management. You can achieve this, or you can be successful in emotional management only when you are not watching a live account. When you are not watching a live account, how will you use strategy 1 in the live account? But there is a way. You can use strategy 1 in the demo account in the opposite way and use it along with the reverse trading system. How will you use strategy 1 in the demo account? See, what do you do in strategy 1? You open 3 positions, lay one with 20 pips stop loss, one with 30 pip, one with 40 pips stop loss. Target will be, let us say, 40, 60 and 100, or 40, 60 and nothing, whatever. Here what you have to do is, instead of the stop loss, keep the target. Instead of target, you keep the stop loss. Here normally you keep a small stop, high target. So just do the opposite. Keep small target and big stop loss. Instead of keeping 20, 30, 40 pips stop loss, you'll be keeping 20, 30, 40 pips of target. But in stop loss, what you do is, you can keep 40 pips stop loss for one position, 60 pips stop loss for second position, and either 100 pips or no stop loss at all for the third position. So this will help in losing the money in your demo account in the reverse trading system. So this is actually a best strategy to use in a reverse trading system in the demo account, just to lose money, not to make money. Okay, so yes, it's possible to use strategy 1 and strategy 3 this way. Okay, now let us look at strategy 2 and strategy 3, that is using safe martingale and reverse trading technique at the same time. The same rule applies here also. You cannot trade in a live account. I mean, if you have to execute the the safe martingale trades in the live account, you have to watch the account. and I advise that you should not watch the live account if you are using the reverse trading technique. So what is the way for that? Okay, you can use safe martingale in the dangerous mode to lose money in the demo account. If you remove the stop loss from the safe martingale, it becomes dangerous. Let us say you have connected a $5,000 demo account with a $20,000 live account. You just use the safe martingale robo. Just use the safe martingale robo in the demo account without the stop loss. What will happen? $5,000 account will keep on making profits every day for few days. So your $20,000 account will keep on making losses every day for few days. But I can guarantee you that one day your $5,000 account will be blown up. It will happen in a single day when there is a big moment in the market. So what will happen to the live account? Your live account will make at least $4,000 profit. Right? This will happen maybe in 3 months, maybe in 6 months, but definitely not more than 6 months. It will definitely blow your account up within 6 months. So $5,000 account will get wiped out, and you'll definitely make profits in the live account. So second strategy and the third strategy can be used at the same time, but not in the live account. Use martingale, safe martingale in a dangerous settings in the demo account and link it to the live account. So then you can make profits. In this session, we are going to discuss about trade volume. How much volume you should trade in each strategy. Let's look at strategy 1. That is, you are dividing the position into 3. Here you can go up to 1:10. That is, if your account size is $1,000, you can go up to $10,000. That means if your account size is $1,000, you can trade 1 mini lot. Instead of 1 mini lot, you trade 0.03 plus 0.03 plus 0.03. If your account size is $10,000, you can go up to 1 standard lot. So instead of 1 standard lot, you trade 0.3 plus 0.3 plus 0.3. So you can go for up to 2 currency pairs. It's safe. For $1,000, you can go up to 1 euro pair and 1 GBP pair or some other pair. So that's safe. Now, safe martingale. In the second strategy, the quantity should be the same. The first quantity, the first position what you take should be the same as your account size. That is, if your account size is $1,000, your first position should be 0.01. If your account size is $10,000, your first position should be 0.1. Here also you can go up to 2 currency pairs. You can have safe martingale connected to 2 currency pairs, and you can trade in 2 currency pairs at the same time. It's safe. The third strategy is reverse trading technique. Here, what should be the ratio? Let us look at that. See, $300 account, you don't have to apply any money management and risk management techniques here, because you are trying to blow up your account. So normally with a $300 account, you should be trading not more than 0.03, but you can go for 0.1 also, or even 0.2. Don't try to trade standard lot in a $300 account, because there is a possibility that 300 will become 3000 and it will blow up your live account. But up to 0.1 is okay in a $300 account. And you can go for 2 or 3 currency pairs at the same time. And what should be the ratio? Here ratio should be 1:1 if you're trading, if you're linking $1,000 account to a $300 account. Okay, 1:1 is safe. Why 1:1? Why not 1:3? Because the strategy what I have taught you to lose the money, if you use that, your $300 account will make profits in the beginning. You have to have enough buffer money in your live account to take the losses, right? So when you make profits in the demo account, you'll be making losses in the live account. So initially your $300 will become $350, $400 or $500, and your live account will be in loss. So you should have enough margins to take that losses. So $300 and live $1,000 account should be linked with 1:1 ratio, and $300 and $10,000 account should be linked with 1:10 ratio. And it will be quite safe. And if you follow the strategy what I have explained in previous chapter, how to lose a demo account, you will definitely lose your demo account, and your live account will definitely make profits. If you have any more queries, you can always
contact me on Skype or on WhatsApp. I'm always available between 8 a.m. to say 8 p.m. Indian time, but I do travel to many countries very often, but most of the times I'm in India. And my Skype ID is Forex Veda, and my WhatsApp number is +91 93432 60001. So you can always chat with me, message me. I'll take my own sweet time to reply though. All the best, safe trades, make lots of money. Thank you.